Good morning, ladies and gentlemen. My name is Paul Wallace. I'm a trader, a coach, and also I run the London Traders Network. And in a bit of a change to the normal script, today I'm in the interviewee seat, and I'm actually interviewing young Moose Batsford here. How are you, Moose?
Very well.
Well, how's August treating you so far, Moose?
We've been extremely busy here.
Yeah, I know it's been normally I'm used to August just clear off and be out of town and gone for it, but it's almost as if it's everybody's getting ready for the storm that's coming.
I think, well, Bank of America have suggested that everything's in place for some sort of autumn correction stroke crash.
Well, I hadn't read that, but just even looking at the charts, I'm a chart guy myself. Just looking at the charts, I'm getting ready. I think the last few months of the year, they're going to be a bit tasty. There's going to be a lot of opportunity for people, and yeah, you want to be ready for that.
You sound like a grizzly bear.
Of course, Moose, look at me, of course I'm a grizzly
No other way to be, right?
That's kind of need to comment. But anyway, today, what I wanted to talk about was a couple of sort of topics around primarily capitalisation for private traders, and also what are their options going forward. And I know you've had some experience of this, so I wanted basically to tap into that. So invariably, my experience, I've coached thousands of traders over the last 10 years or so, from guys just starting out to guys at sort of tier one institutions, all right? And primarily private traders, I see some very, very good private traders who are actually, really good, doing really good numbers, but invariably the truth is that they are undercapitalized for their particular goals and expectations.
Yep.
And so let's say, your man here, he has a £20,000 trading account, and he finishes the year just doing some long-term trading, and he finishes up 30% for the year. Well, that's a very fine number. He's done a very fine performance. But I'm sure that the watchers can actually do the sums to work out that that's not a living wage that he can generate. So it's about a case of, well, all right, where does that he or she trader go from here? Is that something?
Well, I think the first something that really sticks in the back of my mind is when you're trading, it's about paying your gas bill. Okay, you've got to work out how much money you need to live on. Okay, and somebody I met at one of your trader network evenings, they had a very good job. They were paid in excess of £50,000 a year, and they wanted to jack the job in and borrow $10,000 off their auntie. Okay, and you know who you are. Okay, to start full-time trading. Now, straight away, I just said, you must be mad. Okay, the maths just purely doesn't add up. If you look at somebody like Warren Buffett, okay, consistent returns, let's say for argument's sake 5%, okay. So if you've got 100,000 in your pot and you make £5,000, you're doing as well as Warren Buffett, okay, but you can't live on £5,000, right?
Absolutely.
That's just the most important thing. What are the choices to move on to? Set up a fund, do some managed accounts, but everything's down to track record. Now, I can't reiterate enough, okay, track record is 3 years. Okay, and people say, oh, you can do it perhaps a bit less, you might get lucky, but generally anyone will not look at you, okay, unless you've got a fully audited 3-year track record. And then within that track record, it's not a question of just being lucky and putting it all on red or putting it all on black, okay? It's the curve of the winners to the losers, it's the risk, it's the Sharpe ratios, etc., okay? So, and this is, computerized now. These systems are going through it and looking at it closely with a view to saying, yeah, this guy knows what he's doing, the risk reward is really, really good.
Yep, that's brilliant. Just to take it one little bit back, you're absolutely right there that people, they hate the job, and I get these calls or I see these people in the network, they hate the job and say, listen, Paul, I'm giving up my job, I've got £10,000 in my account, I only need to make £2,000 a month to cover my living expenses, I hate my job, I'm going to go and trade for a living. And they're always a little surprised when I say that is a really foolish idea. Don't do it.
Yep.
Don't do it at all. It's not going to work. Okay. If you hate your job, sort that out. All right. If you hate your job, sort that out. Change your job. Thinking that you can just leap from the frying pan into the fire. And let's just do the sums. If you have a £10,000 account and you need to make a minimum of £2,000 a month, well, you're looking to
20%
make 20% a month. Is it possible to do that? I actually do believe anything is possible in the market. However, what's the probability of you doing that month in, month out? It's not going to happen. It's not going to happen. That person's going to shred themselves mentally and with the pressure to deliver. And it's just going to. And what's going to happen is they're going to blow up and they're going to end back in that crappy job that they hated.
Well, the most important thing is everything is about how much risk you put on equals reward. The higher the risk, the more of the reward, okay? But to make these consistent, you look at Woodford, the fund manager, okay, recently, he's had AstraZeneca, he's had Bats, he's had Provident, all in his portfolios, and he's absolutely had a shocker. Okay, now, in terms of trading, if you make 100 quid today, you can't say, well, there's 250 business days for the rest of the year, therefore I'm making 25 grand a year, because we know trading, all right, yesterday is yesterday, today is today.
Absolutely.
That's the most important thing.
Absolutely, and that's a fantastic point there you make, and what I'd like to sort of kind of almost like free advice to people: if you're thinking of giving up your job, don't. All right, either change your job or find a way to trade around it. Secondly, then in terms of capitalisation, most of these traders who are trading for themselves, they are trading for income, but the reality is they're trading for growth. Namely, they need to grow an account to a size that can sustain them without them having to take, let's call it sort of extra risk on board, more risk than is required. So then, effectively, they have to look at some of the options that are available to them. Namely, that either they sell a signal, or they sell a service, or they do managed accounts, or they move towards being let's say like an institutional fund. Although that, to be fair, that's down it. I agree with you in terms of 3 years track record. Okay, track record trumps everything basically, doesn't it? If you have a good, well audited track record, doors will open to you.
Agreed.
And normally, what I tell people is that you're looking at a minimum of 8 quarters. If you can show 8 quarters, well, then at least someone will have a conversation with you. Okay, it may not lead to anything, but 8 solid quarters, okay, of performance that is fully managed, fully risk managed is a starting block. So in terms of doing managed accounts, now of course there are 10, 15 years ago when I started, that it wasn't really the option, but the technology, as you alluded to yourself, technology has changed enormously in the last 10 years, and we now have the opportunity to as a private trader to run managed accounts. Do you have any thoughts on that?
First thing, check with the regulators to make sure you're not doing anything illegal in terms of the number of managed accounts. That's the most important thing, okay? And as always, everyone's your best friend if you're making the money, okay? You only really find out who your friends are when you're losing the money. And that's really, really important. Because suddenly, in terms of running funds, historically you would have an NAV, a net asset value, every month, which is published and says, this fund this month is up 1%, 2%, 5%, whatever it is. That's really, really good. Everyone loves you when you're making money. Crispin Odey this year, everyone doesn't like him because he's down so much. Suddenly, if you're printing down 5%, 8%, whatever the number is, okay, then you've got the pressure from your shareholders as well. And I know one fund manager at the moment, he's really struggling because he's taking these calls all the time from shareholders going, is this okay? Are we doing this right? Okay. And sticky money is really important in terms of managed accounts, okay? Because if you get one bad trade and all the money runs off, okay, which it can do, then where are you left?
Absolutely, that's sage words of wisdom there from so you're absolutely right. One of the things I would sort of suggest and talk about is it might sound weird, but actually understanding your investor psychology is equally as important as understanding the markets, because as you rightly point out, some of your investors can be your fair weather friends. All right, when, as you say, when you're doing well, they're all over you like a cheap Chinese suit. Okay, but when when you're not doing well, it's like the tide's gone out.
Yep.
Okay, and so that's it's about understanding that investor psychology. What I'll find is, or the experience I'll see from guys at that Traders Network is that they've done well for like 3 to 6 months. They clearly haven't got much of a trading account, and then invariably they're just trying to take any money from anywhere, and it's an opportunity for all sorts of disaster for everybody. On every side of the equation. So being able to understand what you say about understanding what the limits in terms of managed accounts. That these days most brokers are actually pretty good at being able to advise and guide let's say a willing new money manager exactly what their limits are. Some brokers may only allow you to have 3 or 4 managed accounts that are linked to in a kind of master and slave. Others would differ depending upon their own coverage. But indeed, getting that advice and guidance is crucial. You don't want to sort of sell yourself short in that terms. So, is there anything else? You've had experience setting up funds yourself. If you were to sort of looking back, what you wish you'd known then that you do now. What would you say those points would be? Again,
the costs, okay, are huge. In the old days, a prime broker would set up an account, okay, with a reasonable amount of capital, but now it's a really, really big number. You need to have a decent sized pot to basically play the game properly.
Yep.
That's just money under management, money under management, money under management.
Yep.
Because if you can diversify, okay, then you don't have that specific risk of a stock, an indices, a currency going wrong, and then suddenly you're down 10%. Okay, if you can diversify, that's just so important.
Absolutely. And what I'd probably add to that is, in many ways, let's say sort of sophisticated and professional investors, in many ways, they're more interested in the downside than the upside, and that if you can't show that you can manage the downside, if you've just been a lucky punter, then invariably you're not really going to get anywhere. It's about being able to demonstrate that you can manage risk and that actually you are in control of your trading positions as much as anybody can be within the context.
And the final point, I would say, always choose a firm where you have the option, okay, to trade the whole range of products, because if suddenly you get volatility and you see some downside and you're a long-only fund, okay, that doesn't have the facility to buy put options, sell calls and the likes, okay, that's irresponsible.
Excellent. Well, I think we're out of time there as you're giving me the nod. So thank you, ladies and gentlemen, for that. Thank you, Moose, and back to the studio.
Thank you, Paul.